Dear investor, we cover the following topics in this edition. First, valuations. We will look at it differently. New emerging spaces may offer alpha node. That's a thought that we want to share. And lastly, growth and stocks which are growth focused offer themselves for growth investing, maybe offering a great investment opportunity. On the first topic of valuations, let's try and look at it differently. Now, let us take few examples. One, many investors believe that low PE is more favorable as compared to high PE, which is considered expensive. Two, if a company traded at 20p once upon a time and is now trading at 15p, it's assumed to be low valued. Three, is a 20p valuation for a company whose terminal value is in question good? Fourth, how does terminal value impact the overall value of the business? It's not wrong that low P is cheap, but we just want to share that there can be different lengths to this view. In the first example, we see several instances, particularly in global commodities, where a plant set up in emerging markets where there is growing demand for it starts to command higher multiple versus a plant put up in another location, say in the developed world where the demand growth is less there. Here very simply what has happened is that a plant bought for say $1 billion, all of equity money, no debt, but put up in two different locations where again the putting up cost, the land cost, etc. may be very similar but may have a very different market outcomes. Now, some part of this can be explained by margins and growth that one geography offers versus the other. However, particularly in global commodities where global trading volumes are meaningfully large, these advantages don't sustain for too long. If we see many of our so-called undervalued spaces, say in commodities like cement, steel, etc., we would find that domestic valuations are significantly higher than global. And on this point of view, this manner of thinking, while they look cheap on PE, they may not be actually undervalued. Similarly, global banks no longer command a high valuation and must at most trade at similar to our, let's say, public sector bank valuations. Hence, question is banks as a space undervalued? Globally, everything trades at that valuation. Hence, frame of reference is very important. It's always a comparison. What you compare a stuff with is very important to understand whether it is cheap or expensive. Now, in the second example, if the growth delivered by the company was say 30% when the valuations were at 20p, now if the growth reduces to 10%, say, would the company not need to reflect the new growth realities? The point is that valuations should be adjusted for growth. Also, this is another manner of thinking. Also, in the same space, there may be entities which always grew at 10% and had a 10p, for example. In this context, another view could be that the true value of the 20p company may be just 10p, which means it is still expensive. Now, we have tried to keep the example simple for ease of understanding and try and point out that frame of reference is very, very important. Most investors use only one-time static domestic frame of reference of one indicator per space, mostly PE, and hence this narrative of cheap versus expensive becomes very difficult to explain. In the third example, today there are a large number of industries which are getting disrupted in the world. Let's take that. Mostly we are moving away from, let's say, fossil fuels, we are adopting EVs, etc. Now, when such a trend is happening, new investments mostly would not occur in these spaces which are at the end of their life cycles. This means that many of these spaces may see higher margins and profits for the remaining part of their existence because some demand still exists and new capacities won't come in. In fact, some capacities may just drop on the way. This may make them seem cheaper on PE, which will not be correct. Moreover, investors end up doing sum of parts where a declining business is offered a lower PE, let's say by historical standards, and the new business is valued separately on strong growth outlook. Now, this again is mostly not correct because the new business would actually simply over time replace the existing business in many cases in the best case scenario. So, for example, if one believes on, say, only an EV outcome after 10-15 years or only an OTT outcome in media after so many years, one shouldn't do, ICE engine vehicle valuation plus the new EV business valuation. One should just take one composite valuation. Because in this, there is no net new value getting created unless, of course, the new business has a much higher margin, which in most cases may not be true. Now, terminal value has a very significant, mostly it's a single dominant impact on valuations. For example, in a declining industry like steel, in certain countries where capacity shutdowns are occurring, there is a probability that the lowest cost producer will retain some terminal value. However, the likelihood is high that a producer further up the cost chain may only hold a terminal value equivalent to the scrap value of the plant. This should result in sharply different PE outcomes for both of these entities, and a lower PE for one need not mean that the entity is cheap. Overall, we believe that growth and its sustainability is the biggest variable impacting valuation. Higher growth industries command higher valuations versus the lower growth one. A simple DCF over 10 years shows that a 1% difference in compounded growth over 10 years has an impact of 5% approximately on valuations. Spaces witnessing value migration and headed by focused managements may hence be valued significantly higher than headwinded spaces where growth may be more challenged. On the next topic, new emerging spaces hold alpha potential. Now, alpha is excess returns versus the benchmark. Also, market ultimately follows earning growth corrected for valuations. A stock or a space which offers a higher sustained growth quotient versus the index, especially with valuations close to index, may hence be expected to deliver significant alpha. Now, if the space is new, it would take some time for it to be part of the index, and this helps. For example, software offered this combination in the 90s. Private sector banks offered this combination in 2000 to 2020 period. Now, managers created spaces in their substantially legacy portfolios in those periods and for these new spaces and generated alpha. Now, the current period is very unique. We have seen several high growth spaces such as retail, hospitals, EMS, new tech, defense, renewables, EVs, luxury consumption, capital markets, etc. now represented in the market in a meaningful manner over the last 5 years or so. This has allowed for construction of a fully diversified growth focused portfolios of these new spaces, something that was not possible in the past. For managers like ourselves who don't have a close to the index positioning, this provides a very good opportunity. We are growth focused, growth in earnings focused managers. Now, we have been communicating hence that this is time for alpha. Coming down to the next topic, growth offers a great opportunity to invest. So, growth is a space in the market which got cut substantially in January. We think is at levels which again can provide very strong alpha generation over the next period. Let us look at various kinds of FPIs and how their actions may be as we go forward. We divide the FPIs into following 4 types. One, arbitrage seeking funds. These are more of the debt variety, but we count their activities as a part of investing into equities. Hedge funds, alpha seekers, long only funds. So these are the 4 types of FPIs, and let us see how they may be behaving. The month of January and the first half of Feb has seen a sharp cut in the high earnings growth part of the market. Our understanding of the situation is that the cut was because of currency movement induced sell-off of the performing part of the market in the prior period of September to December 24. The sharp currency and debt yield movements caused a sharp unwinding of global arbitrage and hedge fund positions, which resulted in the sell-off. Round of panic, rumors, margin calls, etc. caused further damage. Threat of US import duty increasing also caused anxiety, added fuel to the fire. However, now currencies seem to be stabilizing. INR has been below 87 for some time now, and for 3 weeks our forex reserves have also increased. This raises hope that the new levels of the currency may be the new equilibrium. Now, if this sustains, hedge funds, one part of FPIs, could be again be able to take risks again. This should help market find its fair level. US dollar yields have also cooled off after crossing 4.7. As US yields cool off, fund will make a large mark-to-market gains there. This prompted debt, we say arbitrage guys are basically debt guys, to pull back to the US. Since arbitrage can only offer yields and no mark-to-market gains, now this trade can continue for a while till US yields actually reduce and stabilize. Now, an offshore investor would want to invest in arbitrage in India if he is assured of a yield higher than what he will make in the developed market, as this is essentially a riskless trade. Typical assumptions would be that to say that 7% arbitrage returns, from which one subtract a 3% for, say, INR depreciation to arrive at, let's say, ballpark 4% net returns from this activity. Hence, when a US 10-year yield falls to 3.75 or lower, arbitrage chasing money comes gradually and it seems like a strong FPI buying interest. In this period, that is just after a strong currency depreciation, if the currency holds, some managers may subtract a lower number for currency depreciation. So, we assumed 7 minus 3. If it is 7 minus 2, for example, then the break even for getting in money in the country becomes 5%. And we could see some FPI arbitrage driven flows reducing the intensity of FPI sell-off. The third variety of FPIs are alpha seekers. They bet on a manager for alpha. Manager goes long equity in India and FPI shorts an index, for example, an MSCI. While this variety of FPI is slow to react, yet after a sharp correction, chances of alpha in the market increases as the market achieves its fair level. And on the margin, with our theory, the current managers could see some extra flows. Probably, very difficult to find and find new managers in a short period of time that such opportunities present. Lastly, there are FPIs taking a long only call on India, more like our domestic MFs. Now, this is a significant but only a part of the total flows. Now, most of this money comes from EM funds. India dedicated funds are small part of total. We saw outflows back to the US and also in China on sharply different valuation considerations in the past period. Now, this has happened in the past as well. Now that China has had a round of outperformance and relative valuations have improved, move away from India and other geographies to China should also be subsiding. The above thesis on FPIs shows that the odds on FPI selling intensity reducing as we go forward is high. We still expect them to sell, but we expect the intensity of sell-off to reduce. We have seen that FPI sales of around 2 to 3,000 crores a day or lower, the market is able to withstand and actually perform okay. Now, valuations have cracked in general in the growth spaces in general and in growth spaces in particular. A crack in valuations makes equity more attractive versus debt. Funds which allocate assets such as BAF category in India seem to be increasing their equity allocation. This further provides support to the market. Lastly, the fears of US and its duties is manageable. We have de facto to bridge the US dollar 35 billion trade gap. This is a tad over 1% of our GDP. This can be bridged by buying some more oil from the US. Any which ways, we are a very large importer of oil, changing our oil mix in our refineries and maybe some more weapons. Already duties are being reduced in some spaces. Of the total platter of products that not so rich country like India consumes, there is only a very small space where Western products are cost competitive versus what we do, what we can manufacture in the country on account of our lower labor cost. We think impact on the domestic industry could hence be limited. Preferred access to large Western market could be beneficial to us. Our cost structure offers a competitive edge compared to the others. Preferred access to Western and West versus other geographies should also be supportive for Make in India kind of initiatives. There's a great chance that whatever is happening makes us win on the margin. Also, any action could create both winners and losers. Higher import duties on, say, base metals could create great opportunities for value-added players. The problem today is that of high uncertainty and high risk perceptions. As it subsides, the present period may seem to have offered a great entry point, sometimes in future. Now, if we look at how markets have been behaving year by year for several years, we see that Jan and Feb have traditionally seen slower months. This is a period when equities generally experience a downtick for a variety of reasons. March to December has usually more than reversed the losses, and the same happening this period is quite good going by the past 16-year track record. Now, growth as an investing style works best when money available is good and is low valued. Cost of money is lower. This is because growth requires money. We have seen interest rates drop in the world already. US has had interest rate cuts. In India, we have had interest rate cuts. As equity markets normalize on account of factors described above, growth investing style should be expected to come back strongly. We have stress tested our portfolios for export linkages to the US. What part of the portfolio gets impacted if there is a duty implication. Two spaces which can get impacted on larger access given to US companies to India. Third is there stress on the balance sheet. We like cash and book businesses, and of course near term and long term growth visibility. On the above counts, we find that only around 15% of any portfolio in the house is exposed. Here again, outcomes can be beneficial as well. Now, spaces like EMS, renewables, capital market, NBFC and bank, luxury consumption, defense, etc. are all domestic focused spaces and are not impacted by global events. We hence think the risk reward presented by equities at the current juncture and growth stocks in particular is compelling, and ask the investors to take advantage of the same. Thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.